Hello and welcome to today's SWA Take 5. I'm Tendai. This is Jason. Jason, a lot going on in recent weeks. The equity markets have staged a comeback of their own since being noticeably but not abnormally down since the start of the U.S.-Iran war. So today, let's talk about what's driven that rally, right? It's particularly with data that actually says and talking about inflation and earnings, uh, and why discipline still matters in the long run as we look ahead. So with that, tell us, what should investors be looking at regarding the markets in this rally?
Yeah, well, first of all, it really has been an extraordinary move from the lows last month. After a 9.1% downturn in the S&P 500, we had an 11% rally in just 12 trading days, breaking above 7,000 to new all-time highs. To put that in perspective, that is in the 99th percentile of 12-day returns, going all the way back to 1980. And it marks the fastest recovery in the history of the market after a 7+% downturn. So moves like this don't happen very often, but when the markets rally this quickly, momentum tends to look a little bit stretched at times, which means expectations need to be managed carefully.
All right, so then with markets moving and pushing to new heights, how are the markets viewing the geopolitical tensions that are occurring right now, specifically and obviously with Iran?
Well, it's still a real concern. Obviously, it's not as big a concern now that we've had the rally. But since the 2 week ceasefire, the markets have calmed down a little bit. And conditions on the ground, unfortunately, makes a quick resolution seem pretty optimistic. Any potential peace agreement is likely to be a marathon, especially when considering the time it's going to take to see if it's working. Right now, only about anywhere from 0 to 10% on any given day of the normal shipping traffic going through the Strait of Hormuz. So even though oil prices have backed off their highs, the recent highs are still up anywhere from 40 to 50% this year. In fact, the International Energy Agency has warned that current prices may understate the severity of this disruption, and normalization of those markets and that shipping could take longer than the market is currently pricing in. So we'll see. The market is a little bit more at ease than they were several weeks ago, obviously.
Gotcha. Well, it seems like we can't get rid of inflation, all right? And so inflation's been back in the spotlight. What's the latest numbers actually telling us?
Actually, the latest numbers are probably a little bit better than most people think. The headline CPI numbers definitely grabbed attention in March, up 0.9% year over year, or month over month. And that was driven largely by the 21+% surge in gasoline prices. But core inflation has been stable. If you look at core CPI, it was up just 0.2% month over month. Now that's stripping out food and energy, but it suggests that the underlying core inflation pressures are pretty contained as of right now. If we looked at the PCE, which the Fed likes to look at, inflation was up 2.8% year over year in February, while PCE core inflation came down. So as long as the higher energy prices don't spill over into more broad core inflation prices, inflation looks a little bit manageable today. In fact, the market is still pricing in maybe a 50% chance of a Fed cut later in the year.
All right, so it feels like markets have moved past kind of these worst case scenarios, but what are fundamentals such as earnings telling us about the markets?
Fundamentals are actually really positive. Consumers are still spending. If you look at credit card numbers, year over year, hotel bookings, et cetera. And then earnings in the S&P 500 has been a major support. This quarter, earnings are expected to be up about 13% year over year, which will be the sixth straight quarter of double-digit earnings. If we look further out into 2026, Earnings estimates are up 3.7% since the beginning of the year. If that holds, or that revision is the highest in 2 decades. So there's definitely optimism in terms of corporate America. Now, that said, expectations are high. We only have 1 month of Iran-related impacts in the war showing up in Q1 results. So if energy costs and supply constraints and demand falls, the earnings picture could change.
All right, so slight caution there, but after such a strong comeback, what should investors realistically expect looking ahead?
Sure. Well, we remain constructive and optimistic longer term. There are long-term trends, AI. We've talked about that plenty. There are good reasons to maybe expect more volatility than usual. We've already talked about Iran, but this is a midterm election year, and typically volatility is about 20% higher in the average midterm year, even though most years still end up on a positive basis. That doesn't mean that markets can't go higher, but gains might be more incremental from here for the rest of the year. And new highs are not a reason to worry in and of themselves. Historically, after S&P 500 has averaged about a 10% gain in the 12 months following a new record high, which we've seen. So staying disciplined, diversified, and being realistic about short-term possibility of volatility.
Gotcha. Well, Jason, thank you for such timely guidance given the current events in the world. And as we always say, emphatically, the message is simple. Stay disciplined and focus on your long-term financial goals and your plan, and don't ride the emotional roller coaster of the market. So with that, if you have any additional questions, please reach out to myself or Jason or anybody else here at the Saving Wealth Advisors team. And until next time.